Welcome back to Accrued Interest. Today, March 17th, 2025, I'm doing another update in my series called Vibe Check, where I'm not pitching you to go long or short, but I just want to talk through the market, the news, all the ups and downs, and just give you my layman's take on what I think is going to happen next and how you should position your portfolio. As always, everything said on this podcast is for entertainment and educational purposes, as I am not a registered investment advisor. In today's Vibe Check, there's three messages that I just want to get across. First, in some of the data that I'm going to share with you, I think there is a lot of evidence that consumer sentiment is deteriorating at a pretty alarming rate. Secondly, soft data points are pointing to weakness in the economy that I think is going to be showing up more and more in the hard data in the weeks and months to come. And thirdly, I believe many investors, journalists, and all sorts of market participants are slowly moving the goalposts because they do not want to be seen as being critical of the new administration. I've been investing for almost 20 years now, but I am not a trained economist. I read a lot of economic documents, and over the years, I found some economists and some free resources that I just want to share with you that help me stay up to speed and follow developments. A lot of the charts I'm going to show in the next several slides come from Apollo Global Management has a weekly or rather daily newsletter called the Daily Spark, where they put out a lot of interesting think pieces that I think have some good data that helps you understand where we are in the economic cycle. You might have heard in the news about the University of Michigan Consumer Sentiment Survey. It came out a couple days ago at the time of this recording, and here are some data points. First up, the U.S. consumer sentiment is declining rapidly for both households making more than $100K and less than $100,000. If you're watching this on YouTube on my screen, you can see the clear area where it dipped recently. It is not just a blip. I think it's notable that this is happening at both the upper and lower end of the income spectrum, so it's more difficult to dismiss this as an aberration. Secondly, consumer worries about losing their jobs are at levels normally so high we expect to see this in recessions. In the chart over here from Apollo, or rather from the University of Michigan's Consumer Survey, you see the 12-month economic expectations for more unemployment shooting up, went from the low 30s in the prior reading to over 60% in the most recent one. Number three, a record high share of consumers think that business conditions are worsening. Another situation where in the prior reading was in the high 20s, now that has shot up to about 60%. Number four, households' income expectations are declining. That number has gone significantly down in this survey and could show that consumers are afraid of quitting their jobs or moving to something else if they think that their household income is going to be lower in the future than it is today. And number five from Apollo, inflation expectations are rising at an unprecedented speed. This is just yet another example of the data showing a very clear pivot where it got significantly worse over the past couple readings. My second point, that the hard data is starting the weekend, also comes from the edition of the Apollo newsletter that came out on Saturday. Survey of firms show that companies have in recent weeks started to pull back on CapEx plans. CapEx, for those of you who aren't familiar with accounting, is shorthand for capital expenditures. Capital expenditures are goods such as heavy equipment, machinery. A decrease in new CapEx is often a sign that companies do not believe there will be excess demand that will require them to expand their supply capacity. Number two, consumers are getting more worried about their jobs. This is yet another gauge that shows a similar sentiment that I just highlighted in the Michigan survey. So there's some consistency we're seeing in the data. Number three, a plethora of leading indicators. This chart here, if you're watching on YouTube, has about 5 different leading indicators, all point to higher inflation ahead. In this chart, we got the Texas Manufacturing Outlook Survey, Kansas City Fed Manufacturing Survey, the Empire State, that's New York, Manufacturing Survey, the Philly Fed, and the PCE, all showing higher risk to the upside for inflation. Economists at a number of banks and just institutions all over the globe have started to also turn more bearish. I have a clip here from CNBC showing that US and global economic outlook was cut by the OECD as Trump's tariffs weigh on global growth. I've also noticed that I think that some people are starting to move the goalposts in terms of trying to tamper down the bullish expectations that they started the new administration with. Goldman Sachs put out in a research note that their economists now believe that Trump will not lead to the capital markets booming with more IPOs and deal activity, or at least not as much as they initially thought. I'm highlighting from Barron's magazine over the past weekend an article or rather a column that had an interesting premise. It was questioning, when does this economy become a Trump market and a Trump economy? In other words, some of the same people who were saying that the new administration were going to bring a golden age of economic activity are now starting to question publicly whether or not the president has any impact on the economy at all. In the Barron's column, they went on to question, how much sway does the president really hold? They say that the economy is largely run by the private sector. At the same time, others are hedging by claiming that the president is intentionally sending us into recession, and it actually is very clever. Veteran Washington watcher writes that Trump may be acting strategically here. I'm pulling some quotes from the piece for those of you who are listening to this in audio, but this one commentator was wondering if the administration is intentionally sandbagging the economy so they can play the hero later and be rewarded as clever for it. I'm not going to make any predictions as to what the administration's current plans or goals are. I am currently maintaining my modestly bearish stance because not only do I expect further economic indicators to weaken, I think that more economists and market participants are going to have to change their tune. And when investors change their mind, that is what really gets stocks moving. As always, thank you for listening. If you enjoyed this content, don't forget to like and subscribe to the channel.